Hey, it's Market Moves coming at you, and this is probably the best investment advice you're ever going to hear on YouTube today. I've been in the stock market for a long time, and I know the power of it, and if you're not utilizing it to your advantage, you're making a huge mistake. So stay tuned in this video as I go over the advice. So I'm going to make this as simple as possible. There's a ton of stocks to invest in the market. If you want to take as little risk as possible, the best way to invest is just to go with the index. Even Warren Buffett, one of the most wealthiest men in the world who made his wealth from picking stocks, tells institutional investors and individuals to just buy the index. But I'm not going to be talking about that route today. I'm actually going to be talking about how to pick specific stocks that help you out in the long run. So although Warren Buffett preaches buying the index to all investors around the world, I'm going to tell you how to invest like him and how to pick stocks like him. One thing that should be noted, I'm not a financial advisor. This isn't financial advice. So now we got through the legal side. I want to ask you to like this video, and I'll give you 2 seconds to do that. 1, 2, thank you. So let's get into it right now. We're going to be talking about the best stock investment. What makes a stock good? What makes a stock bad? And it all comes down to this. Does the company care about you, the investor? Because if the company does, they're going to do everything in their power to pay you, build wealth and value for you over time. Later in this video, I'm going to give you 3 ways to look for value creation from a company like this. To best understand what companies create value, let's look at Warren Buffett's portfolio himself and see where his $212 billion are allocated towards. And their first holding is Apple. So they have Apple, Bank of America, Coca-Cola, American Express, Wells Fargo, Kraft Heinz, a lot of credit card companies, a lot of banks, and a lot of airlines. They have Delta Airlines, and they have some more down here as well. So Southwest, General Motors. So this whole idea of buying companies that care about you pretty much came from Warren Buffett. So all those companies he holds really care for the investors. So we're looking at all those companies. We want to find what they have in common. The one thing I see is they all have commodity products, meaning they have products people need every day of the year. Flights, cell phones, people always need to buy these products. But there's a lot more behind the scenes that we're not seeing in terms of how these companies treat the investor and how they actually care about them long term. So what I'm going to do now is go over the 3 ways to find out if a company actually cares about their investors. So reason number 1, Warren Buffett looks for these companies almost exclusively are they paying you? Is this company paying the investor? Do they have a dividend yield? It's very easy to find this. So the way to find out if a company has a dividend is if you can go to Market Watch, you can go to Yahoo, you just scroll over the company overview. They just have a lot of different numbers right here. What you're looking for is this yield number. This shows how much they pay you per year. 1.5% is what Apple pays the investor. And it's very important that the company that you're looking for has a dividend, because that is the first sense that it cares about you. It cares to pay the investor each quarter. And then you also want to look at this next key part about the dividend. Is it increasing? Because as the company grows, as it gets bigger, if it just pays the same dividend in the beginning, that dividend is going to get eaten away by what we call inflation. So every year, that amount of money they're paying is getting less and less and less valuable to the investors. So we just need to keep up with inflation, honestly. So you want to check to see if that dividend has been increasing over the past 5 to 10 years. And I actually use this website called Seeking Alpha to see the dividend history. And you can move the cursor based off how many years you want to look at. Apple just started recently paying a dividend, so it's very easy to see just looking at the chart to see if the dividend has been increasing. And as you can see, about every year we're increasing about 10 to 5 cents. So that's really good for the investor to see. It just means you're getting paid more and more each year, and that the company is trying their best to care for that investor. So just think about it like this. Warren Buffett invests in companies that have commodities that people need probably till the end of days. So let's take Kraft Heinz as an example. Warren Buffett owns a bunch of Kraft Heinz. people need ketchup. They're probably going to need it forever. So if this company is consistently raising their dividend, and if they can do that forever, their dividend is going to be pretty big, let's say 5 to 10 years from now. So I hope you understand the power of a dividend and the power of having a product that people are going to need forever. And the second best way to tell if a company cares about you, the investor, is are they increasing the share count? Are they buying back shares and decreasing that share count? So think about your slice of the company as a pie. If they keep adding more slices to the pie, you're going to own less of the company. That's just how it works. But some companies do this cool thing called buybacks, where they buy back shares from certain investors, and the slice of your pie for that company just gets bigger and bigger and bigger. So if a company is doing that, that is like gold. And we'll take Apple as an example. They're paying their investors and they're buying back shares. So you're owning more of the company, you're getting paid more for the lifetime of your holding. And a good site to look at the share count is head to macrotrends.com. There you can see the shares outstanding, and it kind of gives you an overview of if they've been increasing or decreasing. So Apple right here decreased in 2015 5%, 4% 2016, 4% 2017, 7% in 2019 so far. So if a company is constantly decreasing their share count, you're owning more and more of it. Let's say they have a certain portion of money. See that the company is constantly decreasing their share count. If they're still paying out the same amount in dividends, you get paid more in dividends because less people are getting paid. So this is kind of like a double whammy. If they're decreasing the share count, the dividend goes up. So the third and final way to tell if a company cares about you, the investor, is if they're building value within the company. This is what we call the book value. So if the book value keeps going up, what you own is more and more valuable intrinsically. So let's say any financial trouble, maybe they had to declare bankruptcy. In that case, what they're going to pay the investor is they're going to split up all their assets and they're going to pay you whatever's on the portion of the company that you own personally as the investor. So you want to see if the company's increasing those assets more than the debt. So obviously if they're increasing assets and debt at the same time, then it pretty much cancels itself out. But if assets are increasing, book value is increasing, the value of your stock is increasing. And I'll show you how to check this out. So there's this ratio investors look at called price to book value. All that is you divide the market cap of the company by all the assets they have minus their liabilities. So Apple's book value is at 8.84, so price to book value. And we want to check this trend to make sure that their book value has been increasing over time. As you can see, the stock price has easily been increasing over time. And then this next row right here is the book value. So we want to make sure the book value has been increasing, which it has. You get about $20 per share, and that is what you get paid the investor if the company went bankrupt. And because these are the inverse of each other, you want to see the price to book value decreasing, because the closer you get to 1 is basically like saying that everything you own in the company for the stock value, you're going to get back in book value. And sometimes in recessions, you find this unique case where companies are trading under their book value, which just means they own more assets than they're valued at. So which it's a steal at that point. And if we ever have a recession, there's going to be a lot of mispricing with stocks, mispricing with assets, and that's the best time to invest and find these companies, because right now Apple's book value is about 8. So if you put $8 into the stock and it went bankrupt, you'd only get 1 back. But let's say the stock had a price to book value of 1. If it goes bankrupt, you get your whole dollar back, which is so what this video is about. I'm trying to tell you how to find the best investments out there. And I use Warren Buffett as an example. This is exactly how he looks for companies, and it's how you should too. And the whole premise of this theory is that you want to find companies that care about you, the investor. And the 3 ways to find those companies are: you want to find one that pays a dividend, one that's been decreasing the share count, definitely not increasing it. And then the third reason is you want to find a company that is increasing its intrinsic value, or the assets it's producing and saving for that company. So those are 3 great ways to find a company that's going to care about you and grow in the future, pay you a lot of money and do great. If you want more information on investing like Warren Buffett, please click the video to the right of me. I think you're going to love it. And the video below, great investment video. I think you're going to love it. Trade with me personally, 7 days for free. Link to the left. That and the subscribe button to the left of that. Thank you. Market Moves signing off. Peace.